Well, the markets don't melt down after this set of disappointment from US jobs data, and that's perhaps something to look at with a degree of confidence, but not much. And this is where we begin here after another big week of selling for Wall Street. This is Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. And what we're going to focus on here will be what might be the next shoe to drop as we run through all of the really key macro event risk that is going to present itself this week for consideration as catalysts of these financial markets. And probably the very obvious thing to say here is that the focus is going to be on US inflation data because, of course, speculation about the Fed and just how much of a cut they're going to give us next week remains front and center. But let's consider first how these markets did last week and how they ended up this way as a bit of stage setting. So, needless to say, the S&P giving us everything we need to know about how equities performed, a brutal 4.3% sell-off. NASDAQ off more, 5.9%. Yields sharply lower. The 10-year, the 2-year, both down a lot. Interestingly, crude oil also down by a significant amount, despite all of the opportunities one would think from the news flow to go the other way. We did not have a sudden ceasefire that is being very loudly agitated now from within Israel and without, giving us a reduction in geopolitical risk. We had supportive comments from OPEC suggesting they might delay lifting production levels. We have then every reason, perhaps, why crude oil might perform better, and yet this 8% decline suggests it is a growth scare in the works, which of course rhymes quite well with what is going on in stocks and in the bond market. The abiding story last week, incidentally, as we discussed in exhaustive detail on Macro Money all last week, was you had two big pieces of U.S. economic data, the service sector ISM report and the jobs report, and the worst possible outcome for markets looked like it was going to be numbers in line with expectations, not because they were going to be economically terrible. Neither one of them ended up being that, nor were they expected to be as such, but rather because the markets want to know if the Fed is going to cut by 25 or by 50 basis points when they meet next week. And the reason they absolutely want to know this is because for 4 months, from about the middle of April and basically through to now, we have had U.S. economic data that has increasingly underperformed relative to forecasts. And what the Fed has said in June, in May, is that they are not confident enough in the story on inflation, and didn't say that they were confident enough until July to trigger rate cuts. That reluctance before July, even as the data was disappointing, told the markets the Fed is going to overstay at high rates as the economy is already deteriorating. They're going to miss the soft landing window, and we're going to have some sort of an economic downturn. When the Fed finally started to announce that the cuts were imminent in July, the markets took that as a bad thing in that context. When last week we got data in line with expectations, it basically kept the ambiguity in place and left the markets with the sense that the Fed might still do a 25 and be behind, without giving us very positive data that would make a 25 basis point cut feel like it's the right amount. or very bad data that would lock in that 50 basis point cut and give the markets a sense that the Fed is ramping up and to provide relief that way, we were left with maybe they're still behind the ball, but there's not enough negativity to get to the 50 basis point cut, so they're going to be behind. Not surprisingly, the results were defensive. Bonds did well, seemingly less because the markets really moved aggressively on repricing Fed odds, though there was some shifting around, as we'll see momentarily, to a 25 basis point cut being slightly better than 50 odds, but more about risk aversion, more about capital coming out of stocks and going into bonds, perhaps overwhelmingly as a safety valve. And of course, because the markets anticipate that if the Fed misses their window, they're going to have to cut faster later. Crude oil, in that sense, fits within the Fed missed the window narrative around growth concerns. Gold is stuck because the US dollar does reasonably well, despite its sort of soggy performance on the week overall. We can see the euro is up 0.3% here. So the dollar on the whole puts in about an unchanged week. But if we look at the way it performed in the latter half of the week versus the former, when the risk aversion really heats up, the dollar does well, as does the yen. It has a much more ambiguous rally of 2.5%, which of course rhymes with lower yields. What's interesting about gold then is it doesn't really manage to do a whole lot of anything, because for the majority of the week, you don't get a clear lead from the dollar and yields in the same direction. And when those two things clash, gold often struggles. It is, in its essence, a foil to yields and a foil to the dollar. And when those two things don't move in tandem, gold doesn't have a clear steering signal. And this is where we find ourselves now this week. Not surprisingly, it will be U.S. economic data and this Fed speculation game that continues to be in focus, but it's not the first thing. And so what we'll do here is go in chronological order by the sequence in which these releases come out. And actually, the first one to really keep an eye on here comes at us from China. The expectation is that when the August trade report comes out, we're going to get slower export growth, down to 6.5% year on year, slower import growth, down to 2% year on year. So we can see the story here for Chinese trade activity has been one of relatively anemic performance, really for the better part of 2 years at this point. And that's testament to how badly the reopening after COVID lockdowns has disappointed. We really have not seen a pickup of any substance in economic activity in China that has shown itself lasting. We look oftentimes here at a chart of Chinese GDP that shows that for 5 quarters running now, that's over a year, we've had a situation in China where real GDP has run above nominal GDP, which is not how that's supposed to work. Nominal GDP is real GDP plus expected inflation. So if real GDP is above nominal, that means that the expected inflation is negative. And when you have a negative coefficient on expected inflation economy-wide, that of course speaks to the absence of demand. If things are on discount, it's because people aren't buying them. And so the price of those things has to fall to try to clear those markets. So an economy that is for 5 consecutive quarters effectively on discount speaks to its demand story being overtly negative. This, of course, would be very discouraging to reinforce yet again. We had some soggy inflation numbers out of China, though they didn't veer too far off expectations just in the past 24 hours here. To have another set of numbers speaking to soggy economic activity, both in terms of internal and external demand, would be a damning sort of thing because, of course, this is precisely why the markets are so glued to the Fed calculus. We, at this point, have a situation where not only does Chinese economic data tend to disappoint relative to baseline forecasts, we can see that's been happening since about mid-April or so, not unlike the US, and speaks to the possibility that these numbers may be even soggier than expected. But global economic data has tended to disappoint relative to forecasts. And if we look at where that weakness is, it is primarily in China and in the Eurozone, which together with the US, the three of them account for 50% of global growth. So if the US were to slip here, it would do so without a safety net from the other big offsetting economies. The Eurozone, of course, and China. So we are looking then at a situation where disappointing numbers on this front would tell us a story about global recession risk if the Fed were to miss their cue. And the markets seem clearly concerned that they're on track to do that. Then, of course, there is the US CPI report. And here we're looking for continued disinflation at the headline, 2.6% year on year expected there. That would be the lowest reading in 3 years, a new 3-year low, I should say. The core seen holding at 3.2%, which is also a 3-year low, but that would be a repeat of the one that was set in July. And the story here likely follows the script of the ISM numbers and the NFP numbers, the jobs report last week, where if you were to get numbers that were significantly weaker than expected, then the market might say, the Fed's going to do the 50 basis point cut. If you got numbers that were a little bit warmer than expected, you might perhaps lock in the 25 basis point cut as long as those numbers were for relatively good reasons. The problem, of course, is if you get anywhere in line with expectations, ambiguity is going to persist. Now, the likelihood that we get numbers so hot that the Fed has to walk back all of its strenuous 2 months of signaling that the cut is on for September, the markets would, of course, go beyond just the kind of panicking we've seen thus far. But also, the probability of such a result is so negligibly low that it almost doesn't bear mentioning. So we're looking at a situation where the markets overwhelmingly expect for there to be a cut. In fact, they, as we can see here, are pricing it in with 100% probability, looking at Fed funds futures. But there's still almost a 30% chance of a 50 basis point cut, which is to say the markets still perceive the economic environment to be weak enough that the Fed would embrace an emergency level measure. This speaks loudly to the idea that the markets believe the Fed may have already fallen behind the curve. In fact, we saw in July's FOMC meeting minutes that some policymakers already favored a cut at that sit down. Ostensibly, you could get to 50 if you got bad enough data that those members and at least a few others were to get on board. And obviously, there is already a contingent in that camp. So the markets are still assigning enough of a chance here that the overall notion that the Fed is behind is a compelling narrative still. With that in mind, if we get CPI data that's relatively in line with expectations, much as we did the ISM numbers, manufacturing was a little bit light of forecasts, but not much. Services was a little bit over forecasts, but not much. Jobs report was a choose your own adventure kind of thing. The headline was very close to expectations. The revision of the prior month's numbers was very negative, but then the jobless rate went down. That was a bit of a positive thing, leaving again ambiguity. And again, the market said, well, none of this is good news because it doesn't unmistakably give a positive health check to the economy and thereby make a 25 basis point cut a good thing. And it doesn't alleviate worries about, of course, the business cycle, which is a thing unto itself, nor does it do anything to cement that the Fed is going to lean in and go big and thereby take whatever fears might still be out there and speak directly to them in an encouraging, ahead of the curve kind of way. So numbers that are basically in line with forecasts might be a big letdown for risk sentiment yet again. The Fed is on their self-imposed blackout window for commentary ahead of next week's policy announcement, so there's not much to go on aside from these numbers. And so tons of focus are going to be here, and afterwards, if the markets don't have much more clarity, it could be another disappointed de-risking akin to what we saw last week. And finally, there is the policy announcement from the ECB. Now, while everybody has been focused on the Fed, the European Central Bank has been quietly floating the possibility that a 50 basis point cut at their meeting this week is a live risk. Now, if we look at what the markets are baking in, it's about a 70-75% chance here that we are going to get a single 25 basis point cut, which is relatively baseline at this point. There's not much surprise to be had. The likelihood is high. Nevertheless, it's not 100%. And so we have then a situation where if there is the cut, that could have some negative implications for the euro, albeit not much. If there is a 50 basis point cut, needless to say, the euro would be in deep trouble, and the dollar is likely to soar as a consequence. But even if the ECB does not do the 50 basis point cut this time, if we look at the way that things are laid out for the rest of the year, there is 59 basis points being baked in for the easing trajectory through the rest of this year. Now, that basically amounts to at least 2 cuts and about a 36% chance that we get a third. If the ECB were dovish enough that that tally would go up, you don't need the 50 basis point cut to make it appear as though there is dovish readjustment that needs doing. And if the general message from governing council members over recent weeks, or at least some of them, is that 50 basis points is on the table, well, then only 2 cuts with only a third of a chance for a third probably feels light. If it's going to be that the ECB is ready for a 50 basis point cut, even if they don't do one, their assessment of the policy path is more dovish than we are currently baking in. And so there seems to be significant downside risk for the euro and upside risk for the dollar here as we go into this announcement, which of course might well be amplified if the CPI numbers and China's numbers are going to touch off risk aversion that then boosts the US dollar on haven grounds, much as we saw in the second half of last week. Just a quick reminder here, inflation in the Eurozone as of last week down to 2.2%. And so the case for a more dovish tilt seems to be emerging. And indeed, the euro has been sliding, if not all of last week, then certainly toward the back half. And that is macro money for today. We're going to dig into all of these individual releases as the week progresses here. China, of course, will come out overnight, so that's that there. But we'll dig deep into U.S. CPI data as well as the ECB rate decision on the show this week. We're here Monday through Thursday, right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and what that might augur going forward. I'm on with Victor Jones for the Price of Truth on Wednesdays, back with Chris for Futures Power Hour on Fridays, on with Victor and Tom for First Call on Sundays, same for this past Sunday. Writing for the News and Insights portion of tastylive.com, and opining sporadically on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for joining. Macro Money is back tomorrow. Happy trading.